On March 28th, the CRA announced that bare trusts are exempt from the new trust reporting requirements for the 2023 tax year. While on its face this may come as a relief, the announcement has created a significant amount of frustration with taxpayers and their professional advisors. In this video, I will explain the announcement from the CRA last week, the impact on taxpayers who may have had a bare trust reporting requirement, and the reasons why I think the government needs to take notice of their mistakes here and make changes to the way that they roll out new tax policy to avoid even more pain and frustration for taxpayers in the future. And if we haven't met yet, my name is Mark Walhout, and I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so you're alerted when new videos are posted. In 2018, the government introduced new trust reporting rules to combat, quote, aggressive tax avoidance, tax evasion, money laundering, and other criminal activities, close quote. Under the previous reporting rules, only trusts that had taxes payable needed to file a trust tax return. Under the new rules, however, all affected trusts needed to file a trust tax return regardless of whether they had any taxes payable. In 2022, the government expanded the new rules to include bare trusts, which are not formal trust agreements, but rather situations where one person holds legal ownership of property on behalf of another person who is the actual beneficial owner. Common bare trust scenarios include, number one, parents who are on the title of their children's homes at 1% so that the bank will qualify them for a mortgage. Number two, adult children who are listed on their parents' bank accounts to help with their day-to-day financial management. And number three, adult children who are on the deeds of their parents' houses as a way to speed the estate process when their parents pass away. The problem with these bare trust arrangements is that they are not always apparent to the average person who may be part of one. However, when the new bare trust filing requirements were announced, they were accompanied by a set of financial penalties for failure to follow the new rules. The fines for failure to file were set at $25 per day up to a maximum of $2,500. And if the CRA deemed that the failure to file was done knowingly, a fine of up to 5% of the maximum value of the property held during the tax year by the trust could be applied. To put this in context, that means that a parent who is on the title of their child's $1 million home at 1% ownership as a bare trustee could have faced a fine of up to $50,000 if the CRA deemed that they knowingly failed to file a T3 return and were negligent in doing so. Financial advisors, accountants, and taxpayers have been raising alarms to the CRA and the government since these rules were introduced in 2022, and the outcry reached a fever pitch this spring as unknowing taxpayers and their accountants scrambled to complete these complex trust returns ahead of the deadline in order to remain compliant. And the paperwork to complete a T3 return is no small task either. It requires getting a trust tax number, gathering the full legal names, dates of birth, addresses, and social insurance numbers for all of the beneficiaries, and completing multiple lengthy CRA tax forms. On March the 12th, the CRA finally responded to the outcry from the tax community and Canadians at large and indicated that they would not impose any late filing penalties or fines for bare trusts, except for in the most egregious circumstances. Some relief, yes, but they did not move the deadline, so the requirement to file the returns by April 2nd for the 2023 tax year remained. Tax preparers pushed forward and encouraged their clients to remain compliant to the deadline. Finally, on the very last business day before the deadline, last Thursday on March 28th, the CRA announced that they were removing the trust reporting requirements for all bare trusts for the 2023 tax year. They indicated that they will work with the Department of Finance over the coming months to further clarify its guidance. So any taxpayer who proactively worked to get their trust tax returns done on time and remain compliant to the rules had already spent the time and money to do so. Before I continue, I will clarify that this channel is not meant to be political or discuss politics, but the confusion and frustration around the rollout, lack of response to feedback, and last-minute removal of the trust tax reporting rules can all be laid at the feet of the government and the Department of Finance. I personally know several tax professionals and individual taxpayers who wrote letters, participated in roundtables, and petitioned the CRA and the Department of Finance to clarify these rules, delay the deadline, or remove the rules altogether. For the government and Department of Finance in particular to wait until the very last business day before the deadline to lift these rules, after all the time, energy, and money had already been spent by law-abiding and proactive taxpayers and their professionals, this is a huge slap in the face. I know of many tax preparers who are now struggling with the dilemma of whether or not they should charge clients for the many hours of work that were put into completing these returns, only for them to now be deemed unnecessary. And what about the taxpayers who have already paid their accountants for trust tax returns that are now redundant? Will they ask for refunds from their accountants, or will they send those bills to the Department of Finance? Creating tax policy that is fair and aims to combat bad behavior is all well and good, but when the government rolls out policy hastily, and when the policy itself is too broad and unclear, they punish individual taxpayers who are engaging in good faith financial planning strategies. Plus, when they remove the requirements at the last minute, they further punish those who are proactive and want to abide by the advice of their professionals and abide by the law. In this situation, the only winners are those who ignore the rules. The natural consequence of this will come when the government rolls out another new tax policy. Canadians are going to wonder whether they should abide by the new law or simply ignore it, expecting it to once again be removed at the last minute. I encourage our government to consult more widely with tax professionals and financial professionals across the country before rolling out significant tax policy changes, to clarify and limit the scope of any new rules, and to discuss the most efficient and simple way to achieve their aims while reducing or eliminating as much confusion as possible for taxpayers. In its announcement last Thursday, the CRA indicated that they recognized that the new reporting requirements for bare trusts have had an unintended impact on Canadians, and that over the coming months they will work with the Department of Finance to further clarify its guidance on this new filing requirement. In the future, I encourage the Department of Finance to do more of this work up front, not after the work has been done, the money and the time have been spent, and the deadline has passed. To taxpayers, if you have been impacted by these last-minute changes, I encourage you to send a letter to your Member of Parliament to share your experience and ask them what they will do to help us avoid similar issues in the future. Thank you for watching this video all the way to the end. If you liked it, give it a thumbs up, leave your questions or comments below, and I'll speak with you soon. Take care.